I'm going to be introducing Victor Sperandeo, who will be talking about the coming hyperinflation. At the end of his talk, when we do the Q&A, if you could please just go over to the mic. Over here, we've had some people that were just shouting out questions. Didn't work all that well. In any event, Victor's talk is on the coming hyperinflation. In 1944, a bottle of Coke cost 5 cents. I bought this today for $3.49. Maybe hyperinflation's here sooner than we think. I'll give you a brief bio on Victor. If you were at the dinner last night, I learned a couple of facts about Victor. One, he discovered Ayn Rand reading Playboy. And two, people actually read the articles in Playboy. Victor, also known as Trader Vic, is the president and CEO of Alpha Technologies. He's the founding partner of EAM Corporation, a professional trader, index developer, financial market commentator, and the newest addition to the Atlas Society Board of Trustees. Please welcome Victor Sperandeo.
Okay, pleasure. Thank you for being here. You know, I have a little bit of history about this presentation. I read the CBO report in January of 2010 at Congressional Budget Office, and they make predictions for 10 years about what the economy is going to be like through the budget numbers. And when I was reading it, which is part of my job because I'm really a money manager and I create algorithmic trading ideas and things of that nature. I've been doing this since '68 as a trader. I started in Wall Street 2 years earlier. I was amazed at what I was reading. Now, these numbers are put out by the CBO, and they are fed to the CBO by the administration. So they are highly biased. But this was impossible. What they were putting out, thank you, it was impossible. So I really took it upon myself to research what was going on. In the original presentation, the name of this is Hyperinflation, a statistical inevitability. There was no prediction of dates or when it was going to occur. It meant simply, and I basically stated it as such, that if things don't change, then hyperinflation would occur. So I wound up giving this presentation on February 16th of 2010 as a benefit to the Komen Foundation, you know, for cancer, breast cancer, and I didn't charge for it or anything. Normally, this presentation, when people come to me, they say, okay, Victor, we want you to do research because we are a research company. We have 4 people in Houston, and they're literally rocket scientists, engineers. We can test anything. So if you said, Vic, I want to test the Dow Jones long while the transports are short back to 1900, we could do that, probably within a day. So we just have a big database of information where we can test things, and that's what I do, I research. So for this presentation, I would charge, if somebody asked me to do it, I did this on my own, $1,000 an hour. We've done other presentations like this, and then the people in Houston, I charge $500 an hour for things like this. So this is about a $50,000 presentation. Not that you should pay that, but I'm just saying that that's what I would normally do. So this has a background to it. Now, I've got a lot of information here. Impossible to dwell on this as I make this talk. I put it this way, so if any of you want the information, it is free. You just have to give me a card or something with your email on it, and I will email it to you. There are some disclaimers on it because I have 2 lawyers that work for the company, and basically whatever I say here has no meaning according to what's disclaimed in this, if you ask for this. So, okay, let me just start with the fundamentals. Now, I didn't make this presentation for objectivist or Ayn Rand-minded people, but I'm going to convert where I think it's appropriate since you're here for an objectivist conference or an Ayn Rand conference. So I'm going to use that and switch into this. I don't often use those kinds of commentary when I make this presentation. to others. Okay, start with the Austrian School of Economics, which, full disclosure, I am from that school. I mean, I put it this way, I weigh all my economic predictions based on the thoughts of von Mises and Hayek. So just to make, let's say, efficient, it's very rare I ever read it, economics is a science of the means to be applied for the attainment of ends chosen, meaning there's many ways to skin a cat. So you can accomplish, let's say, driving up the economy via Keynesian methodologies, or you can do it in other ways. You can't do it the way Europeans do it. Austerity doesn't drive economic growth, no matter what you do. It basically is a self-defeating policy, in my view. But anyway, many of you may know that I did trade. I'm sort of a hired gun, and I have worked for George Soros back in '81. And always as a consultant, I don't work for people since 1971. But anyway, George had this saying, and you really, there's a couple of things I'm going to try to impart upon you. One, this George Soros quote, and again, we're opposites philosophically, but economic history is a never-ending series of episodes based on falsehoods and lies, not truths. It represents the path to big profits. The object is to recognize the trend whose premise is false, ride the trend, and step off before it's discredited. And again, if you want this, you can have it, but that is a very, very brilliant quote by a man that I disagree with immensely, but when it comes to trading, he was brilliant. And by the way, as I say, some of this information I'm going to go through very quickly, so when it gets to a lot of numbers, unfortunately, which I have to bore you with, but that's what this business is about. Okay, the future is hyperinflation. Now I've switched to, if things don't change, to there is no hope. Okay, it has to occur. Because, and just a little flavor here, as you could see, Ben Bernanke got on TV a week ago. He started to talk that this printing of $85 billion a month forever would someday end, depending on if the economy was doing this and unemployment was doing that, and the markets sold off. It's a musical chairs game. So then the other Fed members, Fisher and Dudley, they came in and they said, no, he didn't really mean that. You misunderstood. So you can see that once you start doing something, once government starts to give away something, in this case, printing money to keep the economy via the stock markets, the only thing that's moving up, stronger, once you take it away, just like if you started to take away food stamps or Social Security or anything, you can't do it. I mean, there's an uproar. So the future is absolutely hyperinflation. Now, the problem is you say, Vic, what's the date and the time? That is something I'll get to, but I can't predict that directly. Okay, hyperinflation and inflation are not the same. They sound the same. You would think that most people would say, well, gee, hyperinflation is just more inflation. Not true at all. Hyperinflation is something completely different. It comes from deflation or a slowdown, which translates to recession or depression. And therefore, the debt explodes, and the government tries to raise taxes. Taxes don't work. So if people don't buy bonds, what happens is the Fed prints the money, and they print it in huge amounts. We are 1920 Germany. Germany lost World War I, had these huge debts. It had to pay reparations. It couldn't pay the debts. In 1920, if you looked at 20 and you look at U.S. today, we had the same problems virtually. And then what happened is the velocity of money, the turnover of money, in 1920 was 1.5. Here it's 1.6. We use M2. And 3 years later, in Germany, it was 12, which means that money turns over once every month instead of every 1.5 times a year. So Ben Bernanke says the deficits are unsustainable, but just so you understand, inflation, if you look into Webster's dictionary, I use the 1960s dictionaries where I went to college, is defined as an increase in the volume of money and credit relative to the goods and services being produced, resulting in a general price increase. So money gets printed, then the general price increase. You don't see inflation today because money is being hoarded, as, by the way, it was in Germany in 1920. Now, hyperinflation was defined by a fellow named Phil Kagan, who wrote a book on the quantity of money. He actually had a foreword by Milton Friedman, and it basically is defined as an increase in whatever measure you have of inflation of 50% in 1 month. That's hyperinflation. Remember, it does not come from like 70s. Hyperinflation is when people don't want the money. They will not accept the money, so they go to gold or they go to other currencies. That's the most, some people buy real estate and things like that. That's a little bit more tricky. It doesn't necessarily work that way. So think of if you have 10 million in the bank, hyperinflation, the next month, August 1st, you have 5 million. And it never comes back, okay? And I'm basically a whiz at this now because I've studied this to no end. But let me make a case of why you're going to get there. There's a professor of economics called Larry Kitlikoff, and he's a professor at Boston University. He basically, and I'm going to try to point with these numbers here, he wrote this, not me, and in 2006, the gross debt was, gross means all debt, meaning not all government debt, Social Security plus debt held by, say, the Chinese and Japan, was 8.5 trillion. In 2012, it was 16.4 trillion estimated. That's fiscal year ending September. Now, that means the debt has grown 5.3 times, a compounded rate of 5.3 times, 92% increase. GDP was 13.3 trillion. That's the number here on the end, this number. And that's grown at 17.5 times, 17.5%, sorry. Now, you cannot have debt increasing at 5 times growth. We get taxes from GDP. It's usually a percentage. 17.7% is the historic 50% return to the government, no matter what the rate is. People change around their lives. So this is the essence of the problem. Debt has grown at such a dramatic rate relative to GDP, which is give you the taxes to pay that debt. Here is, and this is may interest you, this is just for showing, as I say, these are all the hyperinflation events that have occurred in history, and there are 30 of them. Now, this is done by a fellow, the source of this is Peter Bernholz, who's a Basel professor. He's now retired. And he had a book on this, and I got this from his book, and believe me, he knows me because I've given this speech in Geneva, and he got the demand for this book went through the roof, and he now knows who I am because I've helped his sales. But basically, this is his methodology, and again, when inflation goes up 50% in a month, that starts the cycle. But if in the next month it's only up 42%, he doesn't end it. There's another fellow named Steve Hanke, and he counts, well, it ended, and then if it begins again, he counts it as a different one. He is 54. It's really, Peter's is better, but just if you ever see that, you'll say, well, gee, Victor only said there was 30. This guy says 54. He's double counting is what he is. So in any respect, the interesting thing about this table, for example, Germany, in 1 month, inflation was 29,525.7 in 1 month. So you can get a picture that this is a horrible scenario. Whenever I made this presentation, I said, I truly hope I'm wrong here. I hope this never happens. But again, remember, I was a warning. The record is Hungary, which will, if you know anything about baseball, Joe DiMaggio's 56-game hitting streak in America will never be broken, most people say. Hungary's inflation rate in 1 month will never be broken. 129 quadrillion, 500 trillion in 1 month. That's much greater than the nickel to $3.60 Coke. So, I mean, the formula's up here in this corner over here, and it's formulaically written, and unfortunately, that formula, and I'm pretty good at math, it took me about 20 minutes to figure that out. All right, so anyway, that's there for history sake. Now, there are three measures that usually people look at when they get to looking at inflation, if hyperinflation is going to occur. The first one is the percentage the government has to borrow of what it spends. The government spends $1, it has to borrow 40 cents. In every occasion, now remember, there's only 30. It's a small sample in any statistical world of measure, but every case led to hyperinflation. So once the government borrows 40%, it's destined to go to hyperinflation, which the U.S. is. Second is the percentage of debt in any given year. Now, we had been at about 9% debt, if you will, for what was collected. So we collect $1 and we have 10 cents in debt, as the deficit is 10 cents. That would be another measure. That, every occasion that's occurred, except a few minor ones here, Belarus and a few others, has led to hyperinflation. That's 20%. So we're not in that category yet. The other measure is debt to GDP. And the latest and last member of the hyperinflation club is Zimbabwe, and that was 304% debt to GDP. Japan is 226 when I put this in. I mean, their debt to GDP goes up literally every day. I'll explain how they solve their problem in a minute. Here is, and again, I'm going to run through some of these numbers fairly quickly because they're here for your study, not for this talk. But here there is a big discrepancy on what the unfunded liabilities are in the United States. What we owe that we don't count. Let me give you an example. Last year, we had a $1.3 trillion deficit. However, that doesn't count unfunded liabilities. What we owe in Medicare, Medicaid, and Social Security is some of the unfunded liabilities. If you added those unfunded liabilities, you get 6.6 trillion, not 1.3. But the government in the U.S. uses a cash-based formula. They don't use GAAP accounting. So they basically, and every company, including my own, and we have probably 15 people, we have to use GAAP accounting, but the government doesn't. And therefore, it makes the numbers look better. There's another point. Never ever believe a government number of any kind unless you research how it's given to you. That is, in case you use these numbers for any method of making money for yourselves, investment, decision process, they are all bogus, all of them. I can get into detail, but I don't want to sound too cynical. Here is what a parabolic curve looks like here. So you can see that the U.S. debt as a fraction of GDP is starting to turn up like a hockey stick. Whenever this happens, you go into hyperinflation. You can't stop is the problem, just like the example with Ben Bernanke saying, in 6 to 9 months, and someday we'll have to stop printing $85 billion a month, and the markets fell apart. See, they had to cancel that. Okay, just to show you what 1 trillion, and I'm stealing a chart here that I really liked. This is from a guy named Chris Martenson. And he wrote a book called The Crash Course. He was a scientist, and he became a researcher, and he changed his life around. Basically, if you look at this little dot up here, can everybody see that dot in the background there? Can you see the little dot way up in the sky there? If you took a roll of $1,000 bills, to make $1 million, it would go 4 inches high. So if you took $1,000 bills and you piled them up to make $1 trillion, you would go up 67.9 miles into the sky. And that's that little dot. Can you see that dot up there? I mean, I don't know if this is but anyway, that dot is the ozone layer. I mean, that's how big 1 trillion is. Now, we have stated debt of 17 trillion. You see how much money? Nobody ever talks about paying off the debt. The question is paying interest on the debt. You don't pay the interest, you grease, you default. This is again, just a chart to show, not a chart to talk about. The top line here is the expenditures. The bottom line, the little blue line down here, is receipts or revenues. You can see the gaps are the deficit. In 2000, we had a small surplus, and you can see going forward here how the debt is constantly increasing. And here comes the problem. The government's throwing you curveballs when it says, well, this year it's only going to be $682 billion. It's down from $1 trillion, so it's going to be 5% of the nominal amounts of money keep accumulating. And that money has to pay interest. And that is the problem. You have to pay the interest on that accumulated debt. All right, here's a bit of history on inflation. This is from the U.S. government, from the Bureau of Labor Statistics. These are official numbers. These are not mine, BLS numbers. And you see from 1913, when the Fed was created, up until effectively when Nixon went off the gold standard, which was the official, we're off the gold standard. We went off really in 1933. But the official going off of the gold standard, you had about a 10% slope of inflation, which was about 2.2%. After you went off the gold standard, you notice the slope of the curve now is a 50-degree slope. That now means, and I mentioned this last night, from the day we went off the gold standard to date, the compounded rate of inflation in the U.S. is 4.2% compounded annually. If you want to know why the middle class in America is having a hard time, think about it. That $8,000 in 1971 is $50,000 today. So now but you have more taxes. So the middle class is getting eaten alive by the Fed printing money to the tune of this kind of increase. The Bureau of Labor Statistics now has changed 3 times in a major way how they calculate it, because they don't want you to see the real number. That's why I'm saying if you ever believe a government number, you are officially a chump, no insult intended. Take a look at this commentary. I'm going to read this. This is from the Monthly Labor Review. It was an article about the common misconceptions about the CPI. The CPI, I read this, every time I read this, I shake my head. The CPI's objective is to calculate the change in the amount consumers need to spend to maintain a constant level of satisfaction. Now, if anybody really understands what each consumer's level of satisfaction is, and we're going to make the price of steak and Ferraris or Toyotas or whatever the consumer is, it's absurd. It's they can make that number anything they want. The woman that runs the BLS, she is a far left biased person. Erica Gorshin, her name is. Anyway, to keep going, here, this again is for reference. I'm going to skip this. It shows you the various growth rates that took place in the United States in various periods. It's interesting if you're reading the whole thing. I'm not going to go through all these numbers. I'll put you to sleep. Here is a chart that in one full swoop, when you went to college or even late high school, you learned about Keynesian economics. And this one chart, it sort of buries Keynes in his tracks. It disproves his theory that government spending and printing money or zero interest rates will keep the economy growing. Now, I'm not saying Keynes didn't have a point in 1933 to get out of a depression. If you use it occasionally when it's needed and you stop, and that was his theory, by the way, he never said to print all the time. Or to spend, for the government to spend money all the time. He actually said that when you have surpluses, you should pay down the debt. But what this shows, the top line here is government spending in 1903, it was 3% of GDP, 3%. And what this top line here shows, if I can, again, I'm a little bit at an angle, so I don't know what I'm pointing at, but it shows the government is 44%. That's state, city, and local U.S. So we've gone from 3% of GDP to 44% in 109 years. Now, what this is showing is this chart on the bottom is GDP growth, gross. It's not net. So what you see is a downsloping GDP and an upsloping government spending in the economy. When I see this, I say, you don't need anything else. The more the government spends, the less growth you get. And there's a logic to that. If your money is best spent by you, you can invest it better, you can spend it better. You give it to a bureaucrat, he doesn't care what he spends it on. Look at some of these IRS parties they have, and they spend it on line dancing and Star Trek. In other words, it doesn't mean anything to them. So basically, they spend it inefficiently. They don't make it productive. Okay, so if you believe in Keynesianism after that, come and see me and I'll get you to a good psychiatrist. Here is why, as I said, never has there ever been an occasion, only 30 occasions, I would be shot down by statisticians for that. Have you ever had a country not go through hyperinflation when it spends 40% of GDP, 40% of its, it borrows 40% of its expenditures? Now, it is declining, so it's less. It doesn't change anything because you're still not paying down the debt. You're ever increasing the debt, and you're ever beholden to borrow. Here is, if you look at just the top of my slide here, if you were at the dinner last night, you heard the Senator Ron Johnson say 30 years is really, we don't want to talk about 30 years. Originally, I had 30 years in here, and I put on top, there is no hope. And that was for 30 years. But I was saying, well, you still had time to fix this problem. Here is the OECD, the Organization of Economic Cooperation. It's a world organization. And these are their projections, and you can see these little red dot lines going up. Those are 30-year projections if nothing changes. And basically what they're saying is debt to GDP is anywhere from 300 to 600. Impossible, right? Never going to pay this debt now. If you ever buy a government bond and you're holding it, you have to come and see me. Okay, you can trade them, but you can't hold them. Pension funds have to hold them. Now, is anybody here Japanese? Anybody speak Japanese? Okay. This is how the Japanese are solving their problem of raising money for their 2.26 last reported debt to GDP. This is an ad. You see all these pretty Japanese girls on it. And basically what this ad says in Japanese is Japanese girls like Japanese men who buy Japanese bonds. And believe me, I bought some Japanese bonds. I tried to send it around. I've been to Japan several times. I make some speeches. Maybe it'll help. But in any respect, that is what Japan is now down to in solving the problem before they said, you know what, the hell with the ad and raise, let's just print the money and deflate it away. That's what they're trying to do. Okay, here is an example of what happens in hyperinflation in reality. Now, this is actually the first, you see, notice I put on top, I hope I'm wrong, that was the first presentation. There was Andrew Dickinson White, who was the co-founder of Cornell University. And in 1912, he wrote a book called Fiat Money, Inflation in France. You can download this book for free. It's 60 pages. I highly recommend you read this book. This was the first and only hyperinflation before 1920. It was in a bimetallic standard. Gold and silver were money virtually everywhere until 1920, and then we went on the discretionary paper standard, it's called, fiat money. But this happened in France, and France ran into a problem. This is the French Revolution. So Andrew Dickinson White went through and categorized the increase in prices on these various commodities. Now, what the top one here, 1790, a bushel of flour, think of a bushel of wheat, is 40 cents. In 1995, it was $45. Okay, an increase of 115 times, not percent, times. If you look down at gold, for example, one gold franc at the time was increased in 1995, 5 years later, 288 times. Pardon me? Oh, good, yes. That 1795, I'm a little bit ahead of the game in the United States. Okay, you're right. So 1795. So you can see that, and by the way, what I make the case here for is that if you want to hedge hyperinflation, it's pretty easy. Own 5 to 10% of your money in gold and a basket of commodities. Forget about it. It's an insurance policy. And you've hedged your risk because it's going to go up 20 times, right? If you own $1 and you're going to lose and you take 10 cents of the dollar goes down, it's worthless. Money becomes worthless. But the 10 cents goes up 20 times, you're back to square one, or I'm using 5% in this case. So 5 goes up 20 times and you're back to your dollar. So what you want to do is have, and not look at it as a trade, because in this world of this increasing debt all over the world and printing money, something bad is going to happen. It's very difficult predicting when, because what you're predicting in hyperinflation is a run on the bank. You're predicting in the minds of people, because paper is confidence. You give me $10 for some service, and I give you the service, I accept paper money with nothing behind it. I'm taking the paper because I have confidence that somebody else will take it. If I lose that confidence, I will not take your paper money. Chinese invented this invented this it was before 1000 AD. Now, by the way, didn't we start at 11:30? So how long do I have? Oh, okay, good. Okay, keep going. All right. So anyway, that gives you a little bit of although you can't time this, or I can't help you too much with timing, how do you get out of this? Okay, here we go with a few more projections. This is for your information if you want to look at this. This is not for now. I want to get to one page here, which is my projections. The problem with the U.S. and other countries who have this problem with debt is the payment of interest. No one ever talks, you'll never hear a politician about paying off the debt. They will inflate it away, it'll never be paid. But interest has to be paid. Now, when a Fed is printing like it's monetizing the debt, it's buying about 78% of the debt in the last 12 months by printing it, printing the money and giving it to the Treasury and taking the debt. When you get to the stage where they're printing money to pay interest, that's when people have lost confidence and they start to run from the currency, so the dollar crashes, and they run from the debt that people are buying, even T-bills. They take their money and they put them in other countries like Canada or Australia or wherever they trust the currency. So here comes some projections. CBO predicts that in 10 years, we are going to grow at 4.82%. That is, again, another one of these fantasies. That's not going to happen. We grew at 3.95% in the last 10 years. They have no recessions in there. It is impossible for it to do that, especially with raising taxes and Obamacare. There is no hope for that number. But using their number, it basically says that we're going to get real GDP of 2.9, which was like 82 to 99 in the United States. It's just not going to happen. I'm just amazed that they have the guts to put these numbers out there. Taxes they're going to collect on GDP is, in round numbers, 18%. The average interest rate compounded in the last 52 years, I put 50 here for the United States, is 6.2. CBOE says 4.2. You see what I mean? Not going to work. So what you boil down to here is that you're going to have in 2023, 1.8 trillion in interest payments using historical rational numbers, reasonable numbers. And you basically are going to collect about $5 trillion in dollars in taxes, assuming the GDP grows at their rates. Therefore, you're talking about, right now we spend 6% of GDP, 6% of the collected taxes on interest. It's going to be about 33% in 10 years. You see what I mean? No hope. That means that of 5.9 trillion of total collected, you're going to pay 1.8 trillion in interest alone. If you go to just the average, I'm not talking the 1970s kind of interest. Okay, last point, and then we're done. We'll go to questions and answers. Just in case you don't know, you all must make sure you know, 1933, by an executive order of FDR, he changed the Constitution and went off the gold standard. Does anybody not know this? Okay, so even if there's one or two. The point is this. In the Constitution, Section Article 1, Section 8, we're on a gold and silver standard. You have to coin the money. They didn't say print money, they said coin money. All of a sudden, in 1933, FDR wants to print money, i.e. Keynesianism, and spend money he doesn't have, borrow it. So he basically changes the Constitution, which is unconstitutional, with an executive order. Now, was this challenged at the Supreme Court? Yes, it was. But this is corruption 101. The Supreme Court didn't take the case. They said, no, we don't want to hear that case. So could you imagine, seriously, how a Supreme Court, there were 4 lawsuits, and they did not take the case. That's really the story. The fact that we went off the gold standard by executive order, I could understand looking at Obama. He does weird things with these executive orders. But to change blatantly the Constitution and not have the Supreme Court take the case was the 3 branches of government working together to effectively change what were the laws of the land. Okay, with that, I'll take your questions. Again, if anybody wants this, please just give me your card. Thank you.
So the big question is, what do we do? Where can you go? Where, what should a rational person do to dodge this bullet?
Okay, nobody has their phone on here because if the NFSA hears me, what I would do, okay, is you must have an offshore account. I have one, Switzerland will not take more U.S. accounts. And that's because of the problems between the U.S. and Switzerland in these tax cases. And I'm not saying to do anything illegal here. I'm only saying that you open a checking account in Canada. I have mine in Vancouver. I can drive there. It would take a bit of it's 4-hour trip by plane. And the reason you want an account there is that whenever you have issues that you have now, things happen very quickly. You can see them coming if you pay attention, and you don't have to be too esoteric, and you could wire your money to a different country. Because the capital controls, they close the banks, and you can't wire money out of the country. And you're forced to keep a depreciating currency. So that, coupled with having 5 to 10% in gold and silver coins in a safe, along with your guns and a couple of Rottweilers, is the only thing I can recommend on how you protect yourself. So with that, that's the only way because if you saw that chart, the table I gave you from Dickerson White Commodities go up in value. So a commodity basket diversifies you. You don't need much, 5%, maybe 5% gold and silver, 5% commodities. That's what works. And by the way, in 1795, the people that made all the money were currency traders and guys like me, people who bought currencies and got their money out of the country and put them into another currency. That's who made the money. Survived.
Yes, thank you for your talk. I can't agree more. What do you think is the probability of the government confiscating gold the way Roosevelt did?
If it happened once, it can happen again. That's why I said to keep it in your safe, because they can do anything they want as they've proven. Okay, the Constitution does not protect anybody anymore. Yeah. The judges don't abide by the Constitution. I mean, it's worthless. So they can do it. The key is to have some, especially silver coins, because you have to barter. I mean, if you get to this is such a horrible thing to talk about. If you get to this stage, people reject paper. It's going up at such a great rate. And let me just give you a story. I went to Brazil. I made this presentation in Brazil. I run some money, so I met with some very rich families. And they had a 2,026% inflation rate in 1993. So I asked them, I said, what did you do? Okay, just similar to what you're asking me. And basically they had people go to a grocery store like Food Fair or Albertsons or whatever you're familiar with here in the East, and they take at 5 o'clock in the morning and they write down the prices of food every day. And what happens is, and here comes where you might not, let's say, associate to this, because prices go up at such a huge rate, people don't know the value of things. So the example was Coca-Cola. A bottle of Coca-Cola in Brazil in 1993 was, let's say, $1. Well, the next week it was $5, the next week it was $10, the next week it was $50, people wouldn't buy it. Even though they might be offsetting that income, they wouldn't know what the value of the Coke was. So they would do everything they could to hoard the money in interest-bearing instruments or get it out of the country. So what happened? Business stops. Business, except for you go to work, you get paid sometimes twice a day, but the problem is people don't buy things. They buy necessities, see? So you need gold and silver coins. That's all I can tell you.
You mentioned that people should have 5 to 10% in gold and commodities, but the question is, when is the entry point? Right now, gold is having a huge correction. It's getting pretty close to its marginal cost of production. So would you say that right now is a good buying opportunities? And you also mentioned about other currencies as a good hedge for inflation. Are there any particular currencies you like long term? And just one more question is, there has been serious global correction after Fed starts to talk about the tapering possibilities. Do you think in reality they are going to taper? Because if they were to do that, then the interest rates and it may choke off the recovery, or the asset market may collapse, or you think they're going to be just talking about it and just still continue their QE, so the music still plays for a while longer because of the serious overreaction?
Okay. The entry point is not a trade, okay? It is allocating your money just like you'd buy insurance on a home or a car, to make it really simple, or life insurance. It has nothing to do with the entry point. I own gold at 400 and I own it above 1,300. I own it in the mid-teens. And I own most of it lower because I've been doing this since 2004, actually, and I bought gold in the 90s for this purpose. It's an insurance policy. It isn't a trade. So when you buy your 5%, you don't look at it. You don't look at the prices in theory daily. So what happens is when you do a deal, an investment banking deal, and you make $1 million, you take 50,000, you buy more gold, wherever it is. I know that there are a couple of big Chinese banks that have programs where you can buy 1 ounce of gold a month or 1 kilogram of gold a month, and these programs are everlasting, and they, there are ways to keep part of your money always, let's say, ratioed to what your net worth is in theory, so you're investing constantly. It isn't a trade. I wouldn't say buy, if I were trading now, I would not say buy gold here, okay? I would not tell you to buy gold here or silver as a trade. I would tell you to do it as an investment, okay? And long term, and to hedge your, it's not even an investment, it's a hedge against chaos and hyperinflation. Okay, that was the first, I think that was the first question.
And the currencies?
The currencies, Canadian dollar and Aussie dollar are the best. Aussie dollar pays about 3.5%, 3.25%. It's got a lot of industrial commodities and gold and silver. So is Canada. Canada's got a tax rate of 15%. It has very little debt. It has huge oil reserves. There you can get about 1% on your money. And those currencies are very stable relative to the paper currencies of Japan, Great Britain, the US, and Europe. Now, the problem with what Bernanke said was, and by the way, I made this call because I write a monthly letter so somebody can check on it. You had the S&P in May at 19 times trailing earnings. You had a run from early November or mid-November to near the end of May, where the S&P went up about 23.5%, a 47% annual rate, with revenues flat. GDP, as we've just discovered, averages about 1.1% yearly. That's annual rate. 40 in the last quarter, 1.8 in this quarter. It's actually much less, compounding it if you took it quarter to quarter. So where's the beef? There is no GDP recovery. Nothing is good for the economy. The only reason the market's up is because when the Fed prints this kind of money, corporations get their hands on it one way or another. They have no inventory holding costs. They borrow cheaply. They arbitrage the money. It's good for corporate America. Apple pays no taxes, as you see, because it can manipulate what it does around the world. So the point is, what the Fed was trying to do was it was creating a bubble. He tried to talk the markets down. He didn't suggest he was going to stop anything. He didn't sell anything. And what happens is the musical chairs game, without this printing, the markets will come down hard and heavy. They'll get worse and worse and worse as people pile out. So what he was trying to do was slightly ease out of this, because someday it's got to end, and he's being criticized harshly. Bank of International Settlements criticized Bernanke in writing recently. You could look it up, just Google BIS, and you'll see. So he's being criticized. So he was trying to finesse, slowly easing out, and what happens is the markets came down, 8-9%, and he panicked. He stopped. That's why I say you can't take something away once you start to give it. So someday they will, in my view, have to stop the program, but it'll probably be, you probably get to a different kind of catastrophe first, a worldwide problem where they'll lose control. I don't think he'll ever stop in some form, because the markets will stop too.
I have a two-part question, and it begins with if all of my printed money is subject to my faith in the in any system of government, pick one, doesn't really matter, and there are discussions about non-government regulated cryptocurrencies. What are your initial thoughts on cryptocurrency as a medium of exchange for dealing with bank shutdowns like in Cyprus?
I don't have a strong opinion on cryptocurrency, because the banks who can trade this or who accept it, among others, can stop. Gold is money for, J.P. Morgan, to me, is the greatest banker of all time. 1913, and before the U.S. Congress, just before he died, They asked him, what's money? And he said, gold is money, nothing else. Now, that was a wise, successful man, okay? And he was truly successful. So you need to have the physical gold coins in your hand. It's very difficult to barter gold bars. You can store it. I mean, if you have a lot of money and you have a vault somewhere in Switzerland or Singapore or Hong Kong, there are people who store their money in those places. The point is, there is no substitute for me than the real thing, and history shows that. Anything that isn't that can be wiped out, including crypto money. People won't take it. You go to the gas station, you want to fill up your car with gas, I got some money, I'll wire it into your bank, and the bank won't accept it. You see what I mean? It's too dicey. That's a high risk. In good times, okay. Not in these times.
Okay. And as a follow-up, and then I'll get out of your way, there was the most popular application being downloaded in Europe when the Cyprus bank closings happened were cryptocurrency applications in which, and I'm really not sure if you've ever actually just had a look at what the Federal Reserve, what the European Banking Commission, other people are saying about digital money and Bitcoin and the ability to, without any regulation, transfer money between individuals. Have you actually sat down with anyone and said, or seen real person-to-person exchanges in ways that they happened when the government and the banks were going, we don't know what to do?
Well, the answer is no, but I'm now abstracting this conversation to the point where when you go to buy things, and remember I showed you what happened in 1790s, 95s, you buy necessities. Nobody is going to give you their necessities, meaning food, without you giving them something in their hand. Banks will close. Argentina in 2001, this happened overnight. The banks closed. You couldn't do anything with the bank. You couldn't get your money out of a bank. You couldn't wire money out of a bank. You couldn't do anything. So how you transact this make-believe money with nothing behind it in some cases, the Bitcoins, there was nothing behind it. So how you really get there is, as I say, in good times, you can think about new innovations and ideas, and it may work. I'm talking about hard times here. So I don't recommend that. I'm not saying I'm the world's expert in it, though. So you can, if you know more about it than I do, don't let me talk you out of it, but that's my 2 cents.
What would you do in a hyperinflation environment if you were running a manufacturing company?
In the United States?
In the United States or multinational?
Well, for example, there were many other countries that did well. In 1920, we went into a depression because of what happened in Germany. But we came out very quickly, and Calvin Coolidge lowered interest rates, as you know. It was a little different, but everybody suffers. But it's far different when it happens in the currency of the country your plant is in, because what happens is the way they get out of it is to offer you a new currency. So they take your old one at a rate of, $1 million to 1, or, you give me $1 million, I'll give you a new $1. So the point is, I'm only saying that what happens is business slows down. In your case, if people don't buy your products, you will be forced to let the people go that are employed there, and you won't be able to sell your wares because, as I say, as the example that I interviewed literal people who lived through this. I'm an academic here. I didn't literally live through it, but believe me, what I studied, it's like I was there. And what happens is people don't buy things except necessities because they don't know the value of things. So if you're making shirts or suits, I don't need to say what it is, I'm not going to buy a new suit if it's $10,000. I'll wear this one for a long time. Okay? So, it's going to be very, very difficult. That's why I say you got to take your earnings and you hedge yourself. if you buy 5% in gold and silver, well, if you lose 95 cents of your business value, now by the way, real estate and business come back, okay? They only go down because business stops, but they come back, so it's not worthless. It's just that you have to wait a period of time for it. But the value of your gold and silver go up, offsetting by a multiple what you lose in what you own. You know, meaning a business, the value of the business.
One question on my mind is this seems like a little bit of the emperor's news clothes, that the government is running a confidence game in some sense, and at some point the public may lose confidence. Do you see that there are trends out there to uncover this, I guess, deception that's being...
I don't think at this stage, most Americans say it can't happen here. And if you have to be a student of history, you have to, let's say, be willing to read, as Congress is not willing to read anything. You have to be willing to read and study and say, well, wait a minute, what if it happened there, and look into the reasons why it happened, and then interpolate it here, and you can conceptualize it here. You don't even have to use abstract thoughts. You can conceptualize, because if it happened there, it can happen here. Why? For the reasons I told you. Once you get to, and by the way, all this is altruism. I didn't put in the objectivist theories to why this occurs, but it's obviously we have to help people. We have to give them your money so they destroy the nation is what they're doing in the process. But more along your point, sir, is that is that you can look at history, read about it, get fiat paper money in France. It's 60 pages. You'll read it, you know, in 35 to 50 minutes, depending how fast you want to read it, and you'll see what happened to the people. This is a real life example, and this academic. I mean, Cornell is a great university. It was started by this guy who was co-founder. I mean, it's very well done for 60 pages. It'll give you a blow by blow. It isn't similar to today exactly, of course, but it'll give you what happened in the French Revolution.
Thank you. Assuming in hyperinflation, you're going to pay down your fixed mortgage. Is there any kind of benefits or any things to be warned about?
Yeah. Who gets killed in hyperinflation? The people on annuities, if they own government bonds, anything in cash, you lose all your money. I mean, it's very sad. I read a considerable amount. There's a book called When Money Dies. It was about the German inflation. And you read about retired elderly people who did all the right things. You know, they saved and they were wiped out and they killed themselves. And by the way, in this period, taxes, if you didn't pay these, they were raising taxes, it was under the penalty of death. People didn't care. They wouldn't pay the taxes because they couldn't survive. This would kill me one way or another. But the sad part is that in this period, you learn what happens. So if you have a mortgage, it's actually good. Now, here's where it gets bad. If you think, oh, gee, I'm going to buy 300 houses, and I'm going to take big mortgages out on them, the key is the cash flow, right? So you got to be able to pay the mortgage, otherwise you're in trouble personally. Forget what happens to the economy. So if you own a home and you can comfortably pay the mortgage, you should have it even if you can pay it down. Because if you get inflation and if you get hyperinflation, which as I say, in my case, it's 10 years, I'm safe in calling it, you will win because you'll be paying it down with worthless money. Let me just mention one other thing, and I recommend this guy. There's a fellow named John Williams, he's an academic, not like me. He's a serious academic. I'm a serious researcher, but he's schooled as like a professor would be schooled. And he writes a paper called Shadow Stats, and he sells this service. It's very reasonable. It's very cheap, Shadow Stats. And he is predicting hyperinflation, 90% chance next year in 2014. And he basically takes all the economic data that the government gives you and he analyzes it. So I get a lot of my information about bogus government data from John Williams, but he actually analyzes the data. I mean, it's a lot of detail. I mean, like I say, he's a professor. So, I mean, he doesn't teach, but he could. So with that, I will bid you adieu, and I wish you luck, and I'm sorry to, have suggested this horrible scenario, but that's unfortunately what I see.